Okay, it's 10 o'clock, so I think that we will get started here. Good morning, everyone. Thank you for joining us. Going to try to run through a quick presentation here about farm programs. Of course, have a decision on that coming up. And in our webinar series, our business of farming webinar series, I'm planning to do another one of these in early March. But then started hearing from clients pretty strongly here over the last couple of weeks that FSA was bugging you all, of course, about getting those decisions made. So decided we would do something a little bit earlier. Get the discussion started at least, and help maybe get you guided down the right path as best as we can. So we'll roll through this. A couple things real quick. If you want to ask a question, there's a couple ways to do that. At the bottom of your screen, if you're on a computer, or somewhere on your screen if you're on a mobile device, there should be a Q&A button. If you click that, you can type in a question, and I should be able to see it pop up. Or you can go into the chat area and raise your hand if you'd prefer to ask it verbally. And if you do that, I will hopefully see it, and I can give you the ability to speak, and you can ask the question. We can go that route. So yeah, just feel free to use those tools as best you can to ask any questions you come up with. So, all right. So first, just a Farm Bill overview. Obviously, there's at least a couple, maybe 3 different programs, depending on how you look at it. Ag risk coverage, or you'll see it referred to as ARC or ARC quite a bit. And then within that program, there's 2 options. One is ARC County, which is a county-based coverage, or ARC CO, and then ARC Individual, which is based off of your own individual yields and production. And then there's the price loss coverage, or PLC program, that is available as well. You have to make these program decisions by farm number and by crop. So you could, on one farm number on corn, choose ARC County, and on soybeans on that farm number, choose PLC, and then on a different farm number with different crops, choose different options. So, except when you do choose ARC Individual, that is only by farm number. So if you enroll a farm number in ARC Individual, all the crops on that farm number will be enrolled in the ARC Individual program. Keep in mind, any ARC or PLC payments that are due will not be received until approximately 12 months after harvest. So the decision you're making now for the 2021 crop year will be based on things that happen in this upcoming crop year, but won't be paid out until the fall of 2022, actually. The program you choose by March 15th will be in effect for the 2021 crop year only. It's only a 1-year decision. And then also tied into this discussion, even though it's not exactly a farm program, is this supplemental coverage option. And what that is an additional crop insurance coverage that's available, only available if the farm number and that crop are not enrolled in ARC. So they can either be enrolled in PLC, or maybe they don't have any base acres, and so you're not enrolled in any program whatsoever. Would be eligible for SCO. And then payments are triggered under this coverage by county yields. And so that's how it gets pulled into this farm program decision, because it's only available based upon which farm program you choose. SCO payments should be made a little bit quicker than the farm program payments. They should be made in like April or May following fall harvest, different time frame for wheat, of course. So again, with the Farm Bill base acres and program yields, all payments for ARC County and PLC will be paid on 85% of your base acres. I don't know why that says planted acres there. Should just say base acres. And then ARC Individual payments will be paid off of 65% of your base acres, but the payment gets influenced by the actual crops that you plant in a particular year. So right here is one disadvantage why historically we haven't seen a lot of use of the ARC Individual, is that it gets paid off significantly fewer acres than the ARC County or the PLC. So that kind of puts it behind right there from the start. SCO payments, however, the insurance product, if you choose to use that, get paid on your planted acres. So there is no issue where you have more planted acres than base acres, so you're not getting paid and that kind of a thing. PLC payments will use your program yields. So if you remember in the last Farm Bill, you had the opportunity to update your program yields again based on, was it 2013 to 2016 yields maybe? 2013 to 2017 maybe. So each of your farms and crops has a program yield attached to it, and PLC program uses that to calculate your payments. Just a quick disclaimer, anything I say here is very general in nature. Everybody has their own unique situation. When we look at this, that could influence your decision. I used Jefferson County, Kansas as examples for this when I went through things. It was one of the few counties that had all the crops that I needed, had all the information publicly available that I needed. But different counties could certainly have different situations. And of course, the best decision is just not something that will be known for a couple of years. And that's going to depend on what happens with grain prices and crop yields over that time. And unfortunately, none of us can accurately predict either of those things. What we're doing is just trying to help you make an informed decision, an educated decision as best as you can. So unfortunately, we cannot sit here and promise you that one particular program is going to end up being the best program. So let's compare the programs, just kind of talk about how they work. We'll start with one thing I have to introduce that is used in both these programs that we're probably used to by now since we've dealt with these programs for 6 or 7 years, but maybe it was new to us to start with, which is this marketing year average price. So every year, each crop gets a marketing year average price calculated for it. And what it is it's the monthly cash grain prices received by farmers for the 12 months approximately following harvest. It gets weighted based on the percent of crop that farmers actually sell in each month. For corn, grain, sorghum, and soybeans, the time period for that is September to August. So the 2020 crop year, for instance, that we just harvested, that price started calculating in September and will run through this upcoming August. For wheat, it is June to May is the time period for that. Here's an example of what that looks like. The most recent crop year that we have finalized is the 2019 crop year. So here's what the 2019 corn marketing year average price looked like. As you can see, we have an average price received for each of those 12 months. Have the percent of the crop that got sold. You multiply those out, you get this weighted number, and then you add them together. And the marketing year average price for corn for 2019 was $3.56. So again, each crop, each commodity gets a marketing year average price calculated, and that's what it looks like when it's all said and done. Okay, so now we're going to start with PLC. It is definitely the simplest of the programs, so we'll start there. With PLC, each crop has a statutory reference price, so a reference price that is written into law. The reference price can also increase if certain conditions are met. I'm not going to dig too much into that because we're not in that situation for 2021. We're going to be using the statutory reference prices. Payments then under PLC get triggered anytime that marketing year average price ends up being below the reference price. Very similar in nature kind of to how a put option works. You know, you have this price, and if price comes in below that, it's going to pay the difference. The reference prices for 2021 for the 4 main commodities we're going to cover here. Corn is $3.70, grain sorghum $3.95, soybeans $8.40, and wheat $5.50. So the way that payments get calculated for PLC, they're going to take the reference price, subtract off whatever the marketing year average price ends up being, multiply that by your program yield that I described earlier, and then multiply that by 85% of your base acres for that crop. So a 2019 example for corn said the reference price was $3.70. The marketing year average price came in at $3.56. So that gives us a 14-cent per bushel payment. If your program yield was $1.20, your payment is going to be $16.80 an acre times 85% of your base acres on corn for that farm. And then a max payment under PLC gets reached once that marketing year average price is less than the loan rate. But we are very, very far away from that, and hopefully we're not going to get into anywhere near that territory. Here's kind of what it looks like, what those PLC payments can look like at various different price scenarios for each crop, and with an estimated program yield. Main point here is just to say that in extremely low price scenarios, these PLC payments can get pretty substantial. And we've seen some of that here over the last 6 or 7 years since we've had these programs in some commodities. All right, so what did 2019 look like for PLC? Like I said, that's the most recent crop year we have that's finalized. These were the reference prices. And so corn we already covered, ended up with a 14-cent per bushel payment. Grain sorghum 2019 marketing year average price was $3.34. Which triggered a 61-cent per bushel PLC payment. Soybeans were over the PLC reference price, not by much, but they were over it, so there was no PLC payment. And then wheat came in for 2019, 92 cents below that reference price. So like I said, triggered a pretty substantial payment on wheat and grain sorghum in 2019. All right, so here's a little bit longer history then of what these marketing year average prices have looked like. So you can see going all the way back to 1989 up through 2020 and 21. Now these that are in red are just projections. I'm using K-State's projections for these numbers. Keep in mind this 2020 number, we're pretty deep into that marketing year, so that should be a relatively accurate number. The 2021, we are several months from even beginning that calculation. So that is very much a rough estimate at this point in time that could change drastically. For corn, here's your PLC reference price, 370. So we can see over the last several years, spent most of that time just a little bit below that reference price, triggering PLC payments. Right now for 2020 and 2021, not projecting PLC payments. Like I said, especially that 2021 one, that's a long ways off. So a lot of time for things to change. This is what the grain sorghum history looks like. A lot of volatility in that one. And you can see this PLC reference price at 395. So over the last several years, we've had significant PLC payments on grain sorghum, projecting to not have them for the next couple of years. But again, a long ways off. For soybeans, there's your history. PLC reference price of 840. During the life of this farm bill or the PLC program, there has not been any PLC payments on soybeans. We got very, very close the last couple of years. Of course, with recent price action, projecting no payments for the next couple of years on PLC either. And then wheat. There's your reference price. So again, spent several years below it, still projecting 2020 to be below it, and then 2021 to be slightly above it. But again, that averaging period is not going to begin until June. So we're a ways off of it as well. So that kind of gives you some perspective of what this program has looked like in the past. And now we're going to move on to Ark County, if nobody has any quick questions here about PLC. This one is definitely a little bit more complex than the PLC program, unfortunately. So the Ark County program is designed to provide protections against shallow losses that happen at the county level. So kind of a county-wide drought or yield loss scenario or revenue loss scenario, that's what this is designed to cover. It does also provide some short-term protection against price declines because it uses a multi-year average to determine your coverage price. But we're also going to see as we go through this how in times like this, when prices are going back up, that sort of works against you for this particular program. County yield history for the crop is what's used to establish the guarantee. The county actual yield in the 2021 crop year is what will determine the payments for this program for 2021. So it's not your individual yields, it's the yield at the county level. Some counties and crops are going to separate irrigated from non-irrigated, but some do not. You just have to dig in to find out which do and which don't. I guess I would say that the most important impact of this is that if you have irrigated acres and your county does keep them separate, I think Ark County becomes much less valuable on the irrigated acres because it's going to be difficult at the county level to see irrigated yields pushed down too much. Okay, so here's the mechanics then kind of how this program works. So first we have to calculate a benchmark revenue, or you might call it expected revenue. That's going to take the Olympic average of the last 5 years of county yields. That skips the most recent. So for 2021, we're looking at 2015 to 2019. We're going to multiply that times the Olympic average of the previous 5 years marketing year average prices for the crop. So exclude the most recent year, I mentioned that. And then any marketing year average price in that time that is below the PLC reference prices we mentioned before will be replaced with the PLC reference price instead. So that helps to keep the coverage price of this program up a little higher as well. And then there is a plug yield for each crop and county. If one of those years in there was a really bad county yield, each crop and county has a plug yield that gets used instead. So once we have the benchmark revenue, we multiply that by 86%, which is essentially our coverage level in this program, and we come up with our Ark County guarantee. The actual revenue at the end of the year is going to be the county yield for the crop times whatever the marketing year average price for the crop ends up being. To calculate if there's a payment, we just take this guarantee, subtract off the actual revenue, And if the revenue was lower than the guarantee, there's going to be a payment of the difference. The max ARC payment goes back to 10% of this benchmark revenue. So here's a specific example of what that looks like. So like I said, this is Jefferson County, Kansas, non-irrigated corn. We can see what the county yield was from 2015 to 2019. The Olympic average of that is 140.2. The marketing year average price in those 5 years was 370 or below. So we used that PLC reference price instead. Olympic average of that then gives us a 370, what we might call base price for our county. Multiply those together, we get a benchmark revenue of $519 an acre. So that's basically our expected revenue going into the 2021 crop year. To calculate our guarantee, we take that 519 times 86%, gives us a guarantee of 446. Our actual county revenue, like I said, is going to be whatever the yield ends up being this year, times the 2021 marketing year average price, and then the payment will be the difference, assuming the revenue is lower. So if we go over here to this grid, right now our expected marketing year average price, or projected from K-State, is 405, about 405. So this is kind of what we're expecting on price. This top row is the expected county yield. So you can see if we have an expected county yield, basically no projected ARC county payments on this range of prices. And if we have the 405 marketing year average price, we have to get a county yield, down into the low 100s to start triggering an ARC county claim. If price falls, of course, it takes less of a yield loss to trigger a claim. So we can see some scenarios there with a higher yield and an ARC county payment. And then at the bottom, what I tried to do is add in here what the PLC payment would be in each of these price scenarios. Now, this assumes that your program yield is equal to this 140.2 Olympic average yield. So if your program yield is higher than that, your PLC payment is going to be higher. If it's lower, it's going to be lower. But it allows you to kind of compare what that PLC payment might look like versus the ARC county payment. So, again, I think the gist of this is, and this is going to be relatively true for all these commodities, there's not a high likelihood of an ARC county payment going into 2021, and there's not a high likelihood of a PLC payment. That's the reality. So choosing it was going to come down to some other factors probably than just predicting which is going to pay. And so then I have the same type of thing for each other crop. Again, for Jefferson County, I'm not going to dig quite as deep into these because it's really mostly the same scenario that we saw for corn. When this is over too, I will email out to all registrants a copy of this presentation. So if you want to dig a little deeper into these numbers, you can. But again, you can kind of see with expected or projected marketing year average price and expected county yield, we're not looking at any payments. So we're either going to need to see prices go down or a pretty significant yield loss to trigger ARC county payments for 2021. Same scenario for soybeans. Big difference here, I would say, is that in this price range that I'm using, also hardly see any PLC payments. So right now, the projected marketing year average price for soybeans is pretty significantly above that 840 reference price. So, it takes a pretty good yield loss to trigger a ARC county payment, sure, but it's going to take a huge price decline to trigger a PLC payment. So that's a little bit more extreme on soybeans than the other commodities. And then here again is for wheat. This looks a lot like the corn and grain sorghum numbers. Would need a pretty significant yield loss or a pretty significant price decline to trigger ARC county payments, and a slight price decline to start triggering PLC payments. Okay, any quick questions on ARC county before we move forward? All right, well, I'll get into ARC individual then. So ARC individual works pretty similar to ARC county. Like I said earlier, paid off your base acres, and it also works really pretty similar to crop insurance in a way. So like I said, if you do select this on a farm number, you have to select all crops on that farm number to go into ARC individual. Not only that, but all of those crops will be combined for payment calculations. So let's say you have a farm number where you have corn, soybeans, and wheat all planted on it for 2021, and you enroll it in ARC individual. And the wheat ends up terrible, but the corn and soybeans are both really good yield-wise. It's entirely possible that you won't end up with an ARC individual claim because the corn and beans produced enough to offset the loss on the wheat. So that is definitely something to think about. And if you select this on multiple farm numbers, they all get combined for payment calculations as well. So that makes it then kind of like enterprise unit coverage on your crop insurance. Again, payments are only made on 65% of base acres to 85%. The crops that you actually plant are going to determine the weighted amount for calculating your expected revenue. So if you plant the farm number all the corn, only your corn yield history is going to be used to determine your benchmark revenue for the upcoming year. Your actual 2015 to 2019 yield history is what gets used to calculate the guarantee. So if you enroll in this, if you haven't already, you are going to have to submit to FSA your 2015 to 2019 yield history for that farm number. And then your actual 2021 yields will be used to determine payment. So if, on a farm number, you enroll an ARC individual and a hailstorm comes through and wipes it out, that's probably going to trigger an ARC individual payment for you, regardless of what happened at the county level. So it is based on individual. Your guarantee is 86% of your benchmark revenue, just like ARC County, and the payment is capped at 10% of your benchmark revenue, just like ARC County. So let's kind of look at an example then of how this might work. So I just took, we're a non-irrigated corn example here. I took those yields from Jefferson County and upped them all by about 20 bushel per acre, I think. Just kind of assuming, let's say that you have a little higher average yields than the county. So your Olympic average yield over that time is 164. We're going to use the same 5 marketing year average prices. So the Olympic average of that is 370. Your benchmark revenue then is $607, sorry. Your guarantee, taking that times 86%, is at 522. And so then your actual revenue, we're going to look at the your 2021 yield on the farm and the final marketing year average price. So again, we're also kind of assuming that this entire farm number is planted to corn. We don't have any other crops coming in to affect this. Our projected marketing year average price right now is 405. So you can see in this scenario, anything below a 129-ish yield per acre is going to start to trigger an ARC individual claim that then will max out at $46 an acre. Now, the other thing that I did here that's important to understand, so to try to account for the fact that it's paid off of fewer base acres, I went ahead and adjusted these down, these numbers. So in this scenario, if the price ends up being 405 and your yield was 116, you would actually get paid $40 an acre times 85% of your base acres, okay? So if you look back to the ARC County slides and want to compare the per acre payments, you're at least comparing apples to apples in that sense. So you can see, it looks a lot like the ARC County slide. It's still going to take a price drop or a yield loss, but it is based off of your individual yields instead of the county. So where might this be a good fit? Now, we've had some scenarios in the past where we were selecting a farm program for a year that had already happened. And then we could kind of look at, well, how were your yields and is this worth doing? Now we're enrolling for 2021. Yields are basically unknown, except maybe some situations where you have wheat in the ground and you might think at least that you have an idea of what its yield potential is. So where might it be a good fit? So I'd say any farm number you have with yields that do not correlate with the county yield at all. So let's say in a county, very few of the acres are flood prone, maybe 10% or something, but you happen to farm a lot of those acres. Maybe ARC individual looks good for you compared to ARC County, because it's going to be much more likely to trigger when you actually had a loss than ARC County would be. FSNs you have with significantly higher yields than the county average. And the reason that's important is it's then going to create a higher guarantee for you and higher potential payments to help offset the fact that you are getting paid on fewer base acres than you would be with ARC County. And then FSNs planted all to one crop are definitely advantageous for this, because anytime you start combining multiple crops, your likelihood of that combined yield or revenue Going down below that guarantee obviously goes down. Much easier to trigger a claim if you know it's all planted to one crop and the fate is going to be tied to that one crop and one growing season. And like kind of alluded to a second ago, you know, if you have a farm number that's all planted to wheat right now and the wheat looks really bad and you have a higher yield history than the county, this might be something to look at when you feel like the odds are a little higher in your favor that your wheat isn't going to yield very well, and be a little more likely to trigger a claim. Now, again, though, if the whole county looks bad, then the Ark County might look like a better option because you're going to get paid on more base acres. So a few things to contemplate there. So that's kind of a summary of Ark Individual. It's something to think about this year, especially in light of the fact that the other programs don't really project to pay. Now, this one would be in the same boat in terms of it's going to require a drop in prices or a yield loss, but maybe there's a situation for you where having that extra coverage against a yield loss for your yields has some value. So something to think about. Okay, then finally of the programs, we also have to talk about supplemental coverage option. So again, that's the crop insurance product that's available. If the farm is not enrolled in ARC, you do purchase it through your crop insurance agent. So you had to sign up for 2021 wheat. You would have had to have signed up for this back in September. But we do have up until March 15th to add this to your policy for corn, soybeans, grain, sorghum, any other spring crops. What this product does is it provides coverage from 86% of your APH down to whatever your MPCI coverage level is. So it's similar to ARC in that regard, in that it uses this 86% coverage level. The type of coverage that it provides is going to match your underlying MPCI coverage. So if you're carrying revenue protection, this is going to work the same way as revenue protection. And it also uses the same base and harvest prices. And so that actually becomes important this year. So if we think back to Ark County and the base price that it used for coverage is that 5-year historical Olympic average. So like on corn, that is 370, all right? Well, our prices right now are significantly higher than that. But for 2021, the Ark County coverage is still going to be based on 370. And then if our marketing your average price comes in higher than that, it actually decreases the likelihood that Ark County is going to pay, because each bushel that we produce is going to be valued at that higher marketing average price. Whereas with SCO, it's going to use whatever base price we get established here in the month of February. So most likely it looks like to be higher than those Ark County base prices. So that is definitely an advantage for SCO. And then it's going to use the harvest price as well. So if you're carrying revenue protection, for instance, and our harvest price comes in higher, the overall dollar guarantee per acre is going to go up as well. And if the county yields below 86% of the expected county yield, it will trigger a claim, even though the harvest price went up. So in those regards, it definitely looks better than Ark County at this point. And coverage will be on planted acres. So whatever crop you plant this particular year, you'll get SCO coverage on all of those acres, not just on the base acres that you have on the farm number. The premiums are subsidized for this product. I mean, this is obviously the downside of it versus Ark County is free. Supplemental coverage option you do have to pay for, but the premiums are subsidized 65%. And just to kind of outline a little bit of how RMA sets premiums and then applies subsidies, I think that's important. Let's say that they build the supplemental coverage option program for Jefferson County corn, like we talked about earlier. They look at their historical yield data, they run the numbers, and they say, we expect this product to pay out an average of $20 per acre per year over time. They then set the premium equal to that, is how they do it. And then they apply the subsidy to that premium. So in this scenario, a product that's built that they estimate to pay out $20 per acre per year on average, you're only going to end up paying $7 per acre for, because you're only paying 35% of the premium. There are additional admin fees. So if you add this, $30 per crop per county, not a huge deal. You know, sometimes you get into landlords that have relatively small acreage. It is something to kind of think about. The actual county yield, is what gets used to trigger payments. So it is a county-based coverage. It is not based off of your own yields in the particular crop year. All counties will use different yields for irrigated acres versus non-irrigated. That's important. And again, kind of like Ark County, I would say makes SCO in general less valuable on irrigated acres than it would be if it was combined. And then to make it a little tougher, even if there's not enough acres of a particular practice like irrigated or non-irrigated in a county, they reach out into adjacent counties to pull in more yields. So again, on irrigated, you get to reaching out into 5 or 6 counties. It's going to be rather difficult for the irrigated corn yield over 4 or 5 counties to end up being extremely low in most cases. Not impossible, but unlikely. Your crop insurance APH does determine the dollars of coverage that you receive. So if you have higher yields than the county on average, you are going to get a little higher coverage than you would through like Ark County, or than someone else might get that has lower yield history. If you purchase SCO in a county, you do have to apply it to all of the eligible acres in the county. So if you buy SCO on corn in Jefferson County, it has to go on all of your corn that is eligible for SCO, meaning that it's not enrolled in ARC. So this is kind of a visual then of what that would look like. So the different bars here are different MPCI coverage levels that you might carry. The green area shows your revenue protection coverage or MPCI coverage. And then the purple part of the bar shows the SCO coverage. So when you add the two coverages together, regardless of what level you choose, if you have SCO, you're going to have the same total dollars of coverage. As you change your underlying coverage level, you just shift coverage from the county-based SCO coverage to your MPCI individual coverage or vice versa. You kind of see the numbers down here then of what that looks like and some premium estimates. So as you lower your MPCI coverage, your premium on that product goes down. But if you have SCO added, the SCO premium goes up because it's providing more and more coverage. And then you can look at this combined premium and what that looks like at various levels. So pretty unique product in that regard, that how much coverage it provides is going to be dependent on your underlying MPCI coverage level. So just kind of go through some numbers of a loss example, and I apologize, these numbers and this math gets a little messy, but we'll try to plow through it here. So an example here of having an APH of 140 bushel per acre on corn, you're carrying 75% revenue protection already, and we're going to use an estimated base price of $4.50. Then we're going to look at what happens if the harvest price comes in the same as $4.50. We're going to just leave it be. We're going to assume the county APH or expected yield is the same as yours, 140. It may or may not be. It'll certainly be a little bit different. And then we're going to look at what happens if the county yield comes in at the end of the year at 112 bushel per acre in this scenario. So pretty significant yield loss. I believe that is 80% of the expected yield. So first we calculate the maximum SCO amount, or the dollars of coverage it provides. So we take your APH times 86%. Subtract off your APH times your coverage level, and then multiply that by the highest of the base or harvest price if you're carrying revenue protection. So 140 times 86% is 120.4. 140 times 75%, your coverage level is 105. So it is going to provide 15.4 bushels of coverage times your 450 price, gives you $69.30 of coverage per acre for this product in this scenario. So all we're really doing there is trying to calculate the dollars of coverage that are in this purple bar right here. Now to calculate a loss, we have to calculate an SCO payment factor, and this is a real fun one. We take 86% minus whatever the actual county revenue ends up being, divided by the expected county revenue, and then we divide all that by 86% minus your coverage level. So in this scenario, actual county revenue was 504, expected was 630. That gives us, like I mentioned before, an actual county revenue that's 80% of expected. So we take 86 minus 80, we get 6% divided by our 11% coverage range. We end up with a payment factor of 0.545 in this scenario. And then to calculate your actual payment, we take the max payment amount or the dollars of coverage multiplied by your SCO payment factor, and we get an SCO payment of $37.77 in this scenario. So kind of a lot of messy math there, but really all we're trying to do, like I said, is determine the dollars coverage there, decide where the actual county revenue came in as a percentage, and you're going to get paid the amount above that line. Okay, any quick questions then here before we roll on about Ark County, PLC, or SCO? And like I said, click on question and answer at the bottom of your screen, or you can go to the chat and raise your hand if you would prefer to ask it verbally. Okay, so now we'll get into making the decision. So just kind of as a reminder here, we're sort of looking at this trade-off between the value of ARC and then the value of PLC plus SCO potentially, because the only way you can purchase SCO is if you are not enrolled in ARC. So first off, let's just look at kind of some short-term PLC projections. Our reference prices going into 2021, as we mentioned before. Right now, using K-State's projections, these are the projected marketing year average prices for each of those commodities. So none of them right now would be projecting a PLC payment for 2021. But what does the ratio look like? Well, wheat price is projected only 5% above that reference price. Corn and sorghum are about 10% above the reference price, and soybeans are projected right now the most about 17% above that projected above that reference price. So, looking at that, all things being equal, soybeans are probably much less likely to trigger a PLC payment than wheat. And again, just keep in mind that the actual time period, though, when these prices will be established are a long way off. We sit here today looking at these prices. If I went back just 3 or 4 months, these projections for 2021 would look drastically different. And while I certainly hope that that doesn't get worse, there's nothing to say that 3 or 4 or 5 months from now, we couldn't be right back to where we were last summer or fall. So keep that in mind. These are a long ways from actually being calculated, but as of now, not projecting any PLC payments. What about ARC projections? So again, these are the base prices for ARC for the 2021 crop year. These are the current projected marketing year average prices. So then what this tells you is if this ends up being the projected price, this is the percent of expected county yield that you would have to trigger an ARC County payment, okay? So moral of the story here is, again, if these projected prices hold up, then it's going to take a relatively significant yield loss at the county level to trigger ARC County payments as well. The higher these prices go, the more of a yield loss it's going to require. If these prices drop back down, then that increases the yield required to trigger a claim. So makes a claim or a payment more likely if these prices go down as well. So yeah, as an example, if the marketing year average price for 2021 ends up being 405 on corn, you're going to have a yield below 79% of the expected county yield to start to trigger a payment. So again, ARC County payments for 2021 at this point in time are relatively unlikely as well. The next thing to think about, I think, is SCO a good option for you? And I would add in, have you been using SCO in the past? Because honestly, of the 3 programs, it is probably the most likely to pay going into 2021, but it has a cost. So that's the trade-off there. Here's some rough examples. Again, this is Jefferson County. So you'd have to look at your own area, but of what the SCO premium might look like for the dollars of coverage you get across those 4 commodities. So it kind of gives you some idea. It's certainly not free by any means, but it is subsidized pretty heavily. So it's not a hugely costly product as well. Now, for 2021, of course, if you haven't signed up for SCO, it's too late to do so for wheat, but you still can for corn, grain, sorghum, and soybeans. So, as we get quotes out to y'all coming up here over the next 6 weeks, they're going to have SCO premiums on there. And so you can kind of look at that if you want to see if that will affect your program decision at all. And if you want that information now, get in touch with your service rep and we'll try to get you those estimates as soon as we can. So then kind of going through the decision process, I guess I always try to ask this, we try to take things back to risk management as much as just trying to project payments. What do you feel like is your biggest unprotected risk entering the 2021 crop year? And this doesn't have to be the same for everyone. If you're most worried about kind of a widespread yield shortfall, a drought, or whatever the case may be, then Ark County or SCO might be a good option for you. If you're more worried about individual yields, but the county does well, but your individual yields are bad, then Ark Individual might be something to look at to add a little bit of extra coverage for you. If you're most just worried about grain prices falling, I say PLC probably still provides the best protection for that, in theory at least. Ark County provides some protection for it. And as I've said 100 times probably so far during this, fact is we're going to have to see a significant county yield loss or a significant price decline for Ark or PLC to pay out in 2021. Those things could certainly happen, but that's what it's going to take. And then kind of answered this before, but does SCO have more value than PLC or Ark? It probably does right now, being more likely to pay, but there's a premium associated with it. So that certainly changes the equation when the other two essentially don't have a cost. So, the deadline is March 15th, 2021. So, I think FSA, like I said earlier, has been bugging you all quite a bit about this already. So if they haven't been, I would reach out to them and start the discussion. If you make your program election tomorrow, and then for some reason before March 15th, you want to change it, technically you still can. Getting in and getting that done might be an interesting issue depending on how many other people want to. But at least in theory, you do have the ability to change your decision. Summary thoughts, I think in general, grain, sorghum, and wheat both lean towards PLC right now. I say that because, well, wheat is not all that much above as a projection right now, for one thing. And we've seen significant wheat PLC payments over the last 5 years. So reason to think that wheat would be relatively more likely to drop down below that. Grain sorghum right now is projecting to be quite a bit above it. I know grain sorghum cash prices right now are kind of through the roof. But as we've learned over the last 6 or 7 years, that grain sorghum market can be really volatile. It seems to be about 99% dependent on China. And so, who knows what's in store. We've seen over the last 5 years, grain sorghum sold at a significant premium to corn, and we've seen it sold at a significant discount. So I just view that market as a little more volatile maybe than corn. I think corn is very much a toss-up. Probably goes back to what kind of protection you want in place for the upcoming year. Are you more worried about yields? Are you more worried just about prices? And then soybeans, I think, probably still leans Ark County just because we are significantly above the PLC reference price right now. And we haven't yet to trigger a PLC payment on beans for the life of this program. So not to say that it couldn't happen, but have a lot more downside required to get soybeans into that PLC payment range. Maybe this is very much a year where you do some of both programs to hedge your bet. Maybe you have a farm number where Ark Individual is a great fit. And then maybe you put some corn in PLC, some in Ark County, some of beans in each, and then look at if you want to add SCO onto any acres that would be eligible when you look at your coverage. So that's the other thing I don't think I specifically mentioned, but let's say you put some of your corn acres in Ark County, some in Ark Individual, and some in PLC. Well, you can buy SCO and only put it on acres that are in PLC that qualify for SCO. So it doesn't have to be all or none. SCO provides relatively similar coverage to Ark County. It uses different prices. But going into 2021, you'd probably rather use the SCO prices than the Ark County prices. If you're carrying revenue protection crop insurance, I just encourage you to keep in mind you already have coverage in place that's similar to Ark. If there's a widespread county yield loss that pushes your yields down as well, you're going to trigger a claim under your crop insurance policy. So, PLC and the coverage it provides is something pretty unique, actually, that you don't currently really have in place under your crop insurance policy. ARC and SCO, ARC County, I should say, and SCO, definitely both work better for counties with highly variable yields. You know, you get into some, into the corn belt, you might say, and county yields below 86% of expected are pretty rare. You go to central Kansas and non-irrigated corn yields that are county yields that are below 86% of the expected county yield happen quite regularly. So that certainly influences how likely ARC County is to pay out, and SCO as well. Now, SCO is probably also going to have a higher premium in those counties, which offsets that to an extent. And in theory, it's to your advantage to wait as long as possible to make this decision. I think I have a couple FSA people on here, so I want to be careful that while that is advantageous, I would not encourage you to wait till March 15th to contact FSA. That will not go over well. And you could end up just locked into the programs you ran last year. So get in touch with FSA immediately, get the process started, but kind of keep in the back of your mind monitoring some market conditions in terms of if that would have an effect on what you want to do. Okay, I think that that's all that I have. Hopefully that was somewhat helpful. Let's see here, 46 minutes to at the end tell you maybe flip a coin, but it's probably the best we can do going into 2021. So any questions at all? Like I said, use the Q&A at the bottom or raise your hand and I can let you speak if you would prefer. Here's my email information. You're also welcome, if you would like to shoot me an email directly. Obviously, reach out to your service rep for questions that you might have. I would encourage you, if you're on Twitter and Facebook, to follow Ag Risk Solutions there. We do try to post out some relevant information occasionally and not also flood your timeline with a bunch of obnoxious stuff. So. Well, thank you all for joining us, and hopefully this was helpful. I'll hang out here for a little while if any of you do have questions you want to ask. I don't have anywhere I have to be super quick, so I'll hang out. You can ask questions, and but if you want to roll out and get back to work and enjoy the beautiful weather, we've got about an inch of snow here in Atchison, so I don't know how widespread that is, but the radar, I'm guessing several of you are looking at snow out the window.